Capital budgeting is one of the most important things that we're going to visit in this global financial management course. The idea of capital budgeting, and it's sometimes called project evaluation, is to provide some insight on the valuation of a series of cash flows that the firm is considering. The basic decision that the firm has to make is whether to go ahead with the project or to reject the project. It turns out there's many different ways to view the capital budgeting problem or the project evaluation problem. What we're first going to concentrate on is the idea of present value. So we're going to use the tools that we've developed so far, and these tools we've applied to bond valuation and we've applied them to stock valuation. And now we're going to apply them to the evaluation of a project for a particular firm. Now, I've already gone through a simple example in a previous clip as to how to value a project that has cash flows that are different through each year. And the method that we used was to construct a portfolio of zero coupon bonds that had the exact same payoffs as the cash flows that we were trying to value. So if you recollect that example, it was very simple. We had $100 at the end of year 1 and $100 at the end of year 2. And we knew these cash flows for sure, and we also knew that there were 2 zero coupon bonds that were trading in the market that exactly mimicked the cash flows from this particular project. By the principle of no arbitrage, we could construct a portfolio of the zero coupon bonds that had identical payoffs to the project we're trying to evaluate. And the principle suggests that the value of these two investments must be equal, or there's an arbitrage opportunity. And this delivered the fundamental intuition of why present value is used to evaluate investments. The present value makes fundamental sense in terms of eliminating the opportunities for arbitrage or free lunches. So let's go into this into a little more detail now. And throughout the course, we're going to become more and more detailed in terms of this idea of project evaluation. Now, the first thing that we have to deal with is the discount rate that we actually use for the cash flows. It's almost never the case that we know the cash flows for sure. So the discount rate that we need to use for the cash flows of this particular project is going to be greater than the so-called risk-free rate that we use for Treasury bills. The rate that we use is related to the cost of equity, or the required rate of return on the firm's stock. The example that I'm going to look at initially has to do with a project that has the identical risk that the firm has as a whole. Later on, we're going to establish, using the capital asset pricing model and the arbitrage pricing theory, a formula that tells us what the required rate of return is for a project of average risk for a particular firm. And we'll call that the cost of capital, the cost of equity, or the required rate of return. And only in the special case that the cash flows are known with certainty would we use the Treasury bill rate. And given it's almost never the case that we know the cash flows with certainty, we're going to be using this required rate of return on equity. So the example that I want to explore is an example where we're looking at a project that looks identical to the firm that we're studying. Now, this assumption is quite important because when we discount cash flows in capital budgeting, we need to use a discount rate that reflects the risk of the project that we're considering, not the firm as a whole. Okay, this is a mistake that's made quite often, and I'll return to this mistake a number of times during this course. The mistake is that the firm has a required rate of return, and it is a mistake to use that required rate of return to discount all projects back to the present value, because some projects are riskier than other projects. If the project is riskier, then it should deliver a higher expected rate of return, or it's not worth the investment. And if the project is less risky than the average investment within the firm, then it doesn't need to require as much return as the average project within the firm. So I said, we'll return to this again, but the fundamental assumption that I'll be pursuing is that the project looks like the firm. So therefore we can use the required rate of return as the discount rate. So what do we have to do in project evaluation? It's not going to be the simple $100 next year and $100 at the end of the second year. Cash flows are going to be more complex. And in the lecture note, I show how to go through and disentangle the relevant cash flows. There's going to be some initial cost to the project that will be times zero cost, which means that we do not need to discount any cash flow at time zero. And then there's going to be some revenues that the project will generate, and those revenues will probably begin at the end of the first year. These revenues need to be discounted back to the present value. Now, we can't forget that there are taxes, and the lecture note goes into some details about taxes. So one thing we need to do is to figure out what our revenues are, figure out what our expenses are, and then figure out what taxes are due. And that's a real cash flow going out. Now, before we actually do this, we have to deal with depreciation. Now, depreciation is an accounting concept. It's not a real cash flow. So when you're actually calculating cash flows for a firm, you would add back depreciation. But it does have a real implication in that I get to deduct depreciation as an expense for tax reasons. So I'll have revenues, I'll have expenses, and then I'll have depreciation, which can be subtracted. So I can get my net revenues by taking the revenues minus the expenses minus the depreciation. And on that, I calculate my tax rate. And I calculate what taxes are due each year. So depreciation actually is a benefit to the firm in terms of the taxes. And it creates a so-called depreciation tax shield that needs to be added in as a legitimate part of the capital budgeting process. So the basic idea in capital budgeting is to look at the revenues minus the expenses, figure out what taxes are due, and to get the cash flows at the end of each year. In time zero, as I mentioned, we probably have some initial expenses that deal with the project. At the end of the project, there might be a salvage value of the project, which needs to be added in. So we'll have cash flows beginning at time zero, and if it's a 5-year project, all the way out to year 5. And then we apply what we already know in terms of the present value mechanics. We discount each of these cash flows back to the present value. When we do that, we get the so-called net present value of the project. Now, let me distinguish between present value and net present value. often the present value is defined as all the positive cash flows throughout the life of the project, discounted back to the present value. Well, there's an initial cost to the project, and it better be the case that the present value of all the benefits of the project are higher than the initial cost of the project. So when we take the present value of the benefits and subtract the initial cost, then this is referred to as the net present value. And we only invest in projects that have a positive net present value. So we'll often look at these projects and establish whether they have the so-called NPV that's greater than 0. And this is the beginning of the capital budgeting process. Now, as I said, we'll return a number of times to this process and refine it.